Bismillahirrahmanirrahim. 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 Ladies and gentlemen, do we have ladies on the outside? Yes, we do. Assalamu alaikum and welcome to Wessex Jamaat's very first financial management seminar. Before I begin, I must affirm that the contents shared in today's seminar is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. Nothing shared today constitutes a solicitation, recommendation, endorsement, or offer by Wessex Jamaat, the panelists, or any third party to buy, sell, or exchange any securities or other financial instruments or products in this or in any other jurisdiction in which such solicitation or offer would be unlawful under the securities law of such jurisdiction. All contents presented today is information of a general nature and does not address the circumstances of any particular individual or entity. Nothing shared today shall constitute professional and/or financial advice, nor does any information shared today constitute a comprehensive or complete statement of the matters discussed or the law relating hereto. Wessex Jamaat and the panelists are not a fiduciary by virtue of any person's use or access to the content shared today. You alone assume the sole responsibility of evaluating the merits and risks associated with the use of any information or content shared today before making any decisions based on such information or content. In exchange for your attendance today, you agree not to hold Wessex Jamaat, the panelists, or any third party liable for any possible claim for damages arising from any decision you make based on information or content made available to you today. That, ladies and gentlemen, sums up my entire role for today.
Fantastic.
I'm going to hire you as my lawyer. Thank you.
That shouldn't act as solicitation, but we can talk after. Ladies and gentlemen, we've been blessed today with two fantastic panelists. I'll start off with the gentleman closest to me on my left, Brother Reza Hooda. A local to Wessex, so you all know who he is, but a bit of an educational background. Reza read international business and French at Aston University. He's qualified as an ACA in corporate taxation from the ICAEW. He's also qualified as a CTA from the Chartered Institute of Taxation. Reza used to be a tax manager at PwC before joining Walji & Co, where he's currently a partner. Reza also has a fantastic blog, which, whilst it's aimed at coaching and mentoring accountants, there's some fantastic tips there for everyone. I personally have benefited from tips about learning how to mute your emails, and they've been fantastic. The gentleman to my furthest left is Brother Shabbar. He has a Bachelor's of Science in Economics from the University of Surrey. Shabbar was a mortgage advisor at Nationwide Building Society. He then practiced as a financial advisor at Lloyd's TSB, followed by Lighthouse Financial, before starting his own firm. Without further ado, I will hand over to Brother Reza to kick us off.
So, thank you, Manji. Assalamu alaikum, everyone. So I guess the purpose of why we are here, we were requested to put on a Jamaat, wanted to put on a financial management seminar in view of what's going on in the current economy with the cost of living crisis, the macroeconomic conditions that are out there that the UK faces a very bleak future at present, given what's happening in the wider economy. So Jamaat thought it would be a good idea to get us together and see if we can share amongst us, not just us sitting here on the panel, but also in the wider audience. There are others who are also qualified in finance, accounting, and other matters to share whatever we can. So we as a community are armed and have sound financial management in order to withstand whatever current storm is out there, whatever storm may hit us in the future. So we as a community are as protected as possible by utilizing the collective experience, and wisdom from everyone here in the room. So when I was asked to come on as a panelist, I said, I'm not probably too qualified to sit on this panel. Although I'm an accountant and tax advisor, I'm probably better at spending money than saving money. So I thought, but I do know somebody who would be perfect for this. And I thought of Shabbar here to my left, who is an astute financial advisor. He spends most of his time helping people to manage their wealth, to make sure that they're putting enough aside for retirement, pension planning, sound financial planning in terms of budgeting and things like that. So all the right things that I think we need to hear today in order to ensure that we are being as clever as possible with our wealth, maximizing whatever there is, protecting whatever we have in order that it may sustain us for the future, not just ourselves, but our children, our families, and ultimately the wider community. So I think it might be better to pass over to Shabbar, maybe to give a brief introduction, but before that, we want to make it as engaging and interactive as possible. So rather than us just talking at you, it may be better if there are any questions, so feel free to raise your hands, ask any questions as soon as, rather than just being a spiel from here, so that it is as helpful and engaging as possible, because no doubt if you have a question in your mind, somebody else probably has the same question. So please feel free. There is no question that is out of bounds, or there is no question that it's not worth asking. Please feel free to share what's on your mind, so that we can all benefit and learn from each other. So maybe we can just kick off the discussion. Maybe I'll ask Shabbar. Shabbar did a seminar at Stanmore recently on a similar topic. So Shabbar, why don't you just kick off with what was the main theme, or the questions arising from there? Let's hit the cost of living crisis as the number one topic around that area. What questions are being asked, and what advice were you giving to the audience when you did the seminar there?
Bismillah ar-Rahman ar-Rahim. Thank you all for, first of all, having me. It's a great honor to come and share the little that I know with the community at large. So, yeah, it's a real honor to be here. I guess whenever I talk about finance, I think it's always good to just approach it in terms of, what's our goal, what's our intention, and we'll all have different goals and different intentions. So it's actually quite hard and difficult to speak to a varied audience, because we're all on different parts of our wealth building journey. Some are starting out, some are a bit further on, some might be in debt, some might have difficulty with spending, some want to be more tax efficient. So it's just a broad spectrum. But maybe just to spend 5 or 6 minutes just looking at the basics, and then that might open up a broader discussion in terms of where can I add value, and what can I bring to the discussion. When we're managing our finances, I think it's pretty much a standard sort of model of what's your foundation, okay? And foundation has to be knowing your numbers. Any good business owner will know their numbers, or they'll go to someone who can help them know their numbers. And this is just vital, especially in the climate today, because not even taking the cost of living crisis, we kind of got a spending crisis, and that's just purely because the marketing machines that are out there are pumping millions and millions on a daily basis to try and get the money from our pocket into theirs. Now, this wasn't so prevalent in previous years when we weren't online swiping and tapping constantly, but now that's a real problem. So, the generation coming through it, and mine and Raza's, will be very prone to spending as opposed to maybe saving and investing, just because we're spending more time online, and that's a real pull. So knowing your numbers is a real foundation, and we can talk a bit more about that in terms of how do I budget for my own family, if that's something that's of interest. But without knowing what's coming in and what's going out, you've got no ability to build wealth for the future. There is a saying that within the financial sort of planning community, which is pay yourself first, and I think that's probably one of the most useful bits of information that was ever given to me. Was, if you wait to see what's left at the end of the month and then commit an amount to investing from that, it will never happen, because there'll always be something that, you know, either you want to buy or your wife wants to buy, or you think you need to buy for your kids, or whatever it is that will then take that money away from maybe its future goal. However, if you pay yourself first and say, well, do you know what, the most important direct debit that I need to pay is my future, whatever pension pot in, you know, ISA, whatever it is, then you make that investment and then you live off what's left. And that's a great way, I think, to sort of just manage your finances. Don't worry about what you're spending, as long as you've taken care of the biggest thing, which is taking care of your future. And then all of your other bills, and then spend it as you wish, because you've done the hard work, which is putting that aside. So knowing your numbers is vitally important. I think having an emergency fund, there's an alarming statistic. Legal in General have done a study, and it's, you know, I can't remember what percentage of the population, you know, has less than £100 in savings. It's like an alarming number. I don't know the exact percentage, but it just shows that there's a real issue around people being very paycheck to paycheck. Now, I don't know the situation in this community, but, you know, if we look at as a broad spectrum, I think there is this real dependency on day to day, and therefore having an emergency fund of 3 to 6 months of your outgoings is always good practice. So, you know, that's something that's sort of step 2 after knowing your numbers. You know, having an emergency fund, getting out of bad debt, I think is a must, because you can't really build wealth if you're, you know, got high balances on credit cards with extortionate interest rates. So, you know, paying down, you know, bad debt, which isn't helping you to build wealth, is a must. The next one is protecting what's important. Business owners especially, protecting your income. You're quite vulnerable. Your life, in the event of early death, what's going to happen to your family. So making sure that you've got the provisions in place to provide for your loved ones if you're no longer around, I think is massive, and a real responsibility for all of us who are, you know, earning, to be able to put aside the right plans to take care of our family in the worst case scenario. So making sure you've got adequate protection. And once you've done all of that, then you get on to the juicy stuff, which is, okay, well, how do I make my money work harder for me? And that's when we start to look at investing in various tax wrappers, and pensions and ISAs will come up. And they are fantastic ways by which you can build wealth in a very hands-off manner. There's property as well. And we're, you know, Khojas, and, you know, we love property. So, you know, I'm sure many owners of property in the room, and that's a productive asset class as well. So I think those steps are the keys to building wealth. I could spend an hour on each of them. I don't want to, but I want to, you know, engage with you guys and the sisters as well. So I'll open up to sort of any questions, comments, and we can take it from there. And, you know, Reza's here as well with a wealth of knowledge. So hopefully we'll just pass over to the floor.
So, any questions from anyone here? Anything particular, or any comments that you want to make in terms of, you know, what is going on? What is the sentiment that you have? Do you have any worries? Do you have any insights as to where the economy is heading and what we should be doing, where we should be perhaps investing, how we should be acting financially to ensure that we are protecting what we have? And ultimately, with you know, the most alarming statistic at the moment is the rate of inflation. As I'm sure you'll know, double-digit rates of inflation, which we haven't seen in, you know, our middle lifetime, so the last sort of 25, 30 years. We haven't seen these levels of inflation, which means that actually doing nothing is costly. Doing nothing is a risk. Leaving your money in a bank account, doing nothing with it, is a risk, because that money in a year's time will be worth less than it is now. If inflation is still running at 10, 11, 12%, then you're losing 12% of any cash that you have in your account. So even more so that, whereas previously perhaps, you know, investing is never, you know, particularly when it comes to our community, we've been very mistrustful of the markets, of investing in the stock markets, investing in pensions, for whatever reason, cultural, societal, for for some reason our community has always been, and I think it's just the Asian community at large, that property is the thing that we've seen as that is where we should put our money. But actually, if you look at it over the last 30, 40 years, the returns from property in the markets have actually exceeded the returns from property. It's just because, perhaps our knowledge, our experience of investing in the markets has perhaps been not as, you don't see the successes from the markets, you only see the successes from property, I guess, within the community. So are there any questions on that front? What would you like to know? We've got Shabbar here. Shabbar is an expert when it comes to investments, when it comes to ISAs, where to invest, how to get involved, what to look for. So today is your time. There's been a disclaimer put out, but Shabbar is here and happy to give any financial steer, as it were, for any question that you might have. So, anyone want to kick off? Safraz, thank you. Mike, you going to pass the mic to Safraz?
Yeah.
Sorry. So I thought let me just kick off and just create a scenario for everyone. A lot of us, most of us here are healthcare professionals, so I'm just going to create a scenario which I think will be beneficial for everyone. So let's say I'm in my early 30s. I'm a professional. I work Monday to Friday, 5 days a week. I'm not interested in any active investing anywhere because I'm happy with where I am, but I do want to secure my future. So if I am saving, let's say, £10,000 a year, and for the last 3 years, I've saved 30,000. Going forward, I'm going to save another 10,000 for the next 5 years. So, given what's happening in the future, most likely we will be falling into recession. Everything's uncertain. Stocks is uncertain. Everything is. We don't know what's happening. So, what would you advise me at this point, with 30,000 in the bank and earning 800 to 1,000 pounds a month savings? What should I do with my money?
Yeah, I guess it is one for me. Okay, so again, the caveat is that this isn't financial advice, so everyone's circumstances are completely different. But I guess the first thing is, well, do you need the money? Okay, so the first question that you've got to ask yourself is, do you need the money? If you need the money in the short term, i.e. you might need to use the money for children's education coming up, or you've got I don't know, an extension to your house, or you're developing, etc., then you can't invest in a volatile asset when there's the chance that you might need the money in the next sort of 3 to 5 years. The reason being is because generally anything that's stock market based, we would say that don't invest if you need the money within 5 years, because you don't know, no one knows, and that's the thing. Then the biggest thing is that nobody knows what's going to happen in the future. I certainly don't. Reza doesn't. The bods on CNN definitely don't, and the newspapers don't either. So based on that, we need to do what an educated person would do, which is, well, what's always worked? The stock market has always worked. Yeah, historically, the stock market has always worked. I can bring up some slides and we can look at some data, but if you'd invested 10, 15, 20, 30, 40, 50, 60, 70 years ago into the stock market globally, as in not picking a particular company, but broadly, investing in the global stock market, you wouldn't have lost money. Okay, there's no way you could have lost money. Okay, the only way you could have lost money is if your own behavior sabotaged the investment that you made, and you made a decision which was suboptimal. So therefore, going forward, we would do the same thing, invest in the markets, globally diversified at a low cost, in the great companies of the world, big businesses, you'll see a return over decades. And that's the other thing that, we need to focus on, this recession, and actually maybe I'll share a chart, because this word recession as well, the way things are framed is very, very detrimental to our wealth creation and how we behave as individuals. Because don't forget, people prey on fear. News outlets love this sort of thing because it gives them so much ammunition to write about the doom and gloom. But as investors, we just need to be level-headed. We know it's going to be a bad period. The inflation's high, but there's been periods like this before with interest rates that have been high, inflation high, growth low, stock markets. But you need the stock market low. As a 30-year-old, you want the stock market to be low for the next 3 decades. You don't want a high stock market. You want it low. You want to be able to buy units at cheap prices, and then when you come to retire, and then your pot's so much bigger. So looking at it as a long term as well, I think, and how you frame it, that this is a temporary downturn, and it's not going to be a great period. We may need to make adjustments to our individual financial circumstances as well. But again, just doing what always works, investing for the long term, if that's appropriate for you. And again, doing it in a tax efficient way, so utilizing maybe your pensions. Again, we can talk about pensions and ISAs, but yeah, I think that's pretty much what I would be doing, and advising clients in general. If you don't need the money, you invest it. Does that answer the question, or would you like to come back?
Yeah, I think it does to a certain extent.
And we can go through as well. I don't know if there's any other questions. There's some useful stuff that I can share.
One more question.
Yeah, go for it.
So I was just going to ask, would you suggest with spare money at the moment, is it better to overpay your mortgage or to invest?
Okay, again, so that's a fantastic question and a very personal one. So if you when paying off your mortgage or any decision, you can make a decision, I think, from a numerical standpoint or an emotional standpoint. Okay, so you go to an accountant, you might get a numbers decision, but you speak to your wife, you might get a more emotional response, or whatever the situation might be. And the reason being is because me saying, well, actually, no, do you know what? Let's just rewind a few years, so or a year. Let's say when interest rates were very low, people would still come and say, well, should I pay off my mortgage or should I invest? Well, on average, the global stock market, and we'll take the S&P 500 as a proxy for the global stock market. Hopefully, everyone knows or has heard of the S&P 500, but if you haven't, it's the 500 largest companies by market capitalization in the US, and the US being the largest stock market globally, we kind of just refer to it as the global stock market, and because it's about 60% of the global market. So if you invested in that over the last 30 years, you'd have probably averaged around 9-10% a year. Okay, so mathematically, it wouldn't make sense to pay off your mortgage, which is only costing you maybe 1 or 2%, when you can get a return, of 9.5-10%. But when I speak to clients, and it depends on what stage of life you're at, the freedom that you feel if you've paid money off your mortgage and actually see the balance reducing, well, let's say you've managed to clear your mortgage completely, although numerically it might not have made sense, emotionally it was a much better decision for that particular person in time. So there is that problem to solve, and that's an individual one, because I could never say, I could show you, what returns have been. So now fast forwarding, now it's a different situation, because now let's say your mortgage is 6%. Okay, well, we don't know what markets are going to do going forward, so it now is more of a difficult decision, and actually it could warrant saying, well, actually, by paying off my mortgage, I'm getting almost, I'm getting a guaranteed 6% return. Now, a guaranteed 6% return is pretty good. So now you've got a decision to make whereby, okay, well, yeah, do you actually pay some money off your mortgage? Okay, that's an individual decision, but it certainly would be sensible to consider that, in my opinion.
All right, so I'm going to add some flesh to this curtain that you guys have built and make it more interesting. So, from Shabbar's story, because I'm put a bit of a twist to it. So I'm 40, not 30 now, and I'm looking after two two businesses. I'm a trustee of a charitable organization, so I have a community to look after as well as my family. We obviously see a situation where there is a rapid increase in interest rates and inflation is going up. Historically, 5% has been the number, where returns is sort of acceptable. But with current times, that 5 is now going up to 8, 9. Inflation being 10%, the government's announcing 10% increase in minimum wage, which is a big shock to employers like myself. So, the question I would like to put forward is, we discussed two options, stock and properties. Stock is more of a personal thing because there is risks associated with it as well as benefits. If you wanted, which way do we go, given that you don't want to take the risk, especially if you are handling from a trustee point of view, and where you don't want to be criticized or summoned for your actions. But obviously, equally, you want to build up a foundation and hopefully, fruitful future for the community. So, how do we go about taking advantage of the little that we may have to be able to get more for the community?
Yeah, great question, Miqdad. And again, it depends on circumstances, and everyone's view is different in terms of where to invest, how to invest. But I guess our default option or preferred route when it comes to investment, particularly from a community standpoint, has always been property. Why? Because we've seen others do it successfully. Other Jamaats have gone out and bought big property portfolios, and now, alhamdulillah, they're self-sufficient because they started 30 years ago and they've had a good ride over that time, and it's worked out. But the playing field now is a lot different in terms of potential growth. I guess from the community's standpoint, you don't have the tax issues to consider. But if you were personally investing in property, it's very tax inefficient to invest in property these days. With the taxes they brought in, bombarding landlords over the last few years, you're being hit at all angles. From buying it on stamp duty, the surcharge, then you're hit with no interest relief, and then you're taxed on the rental income. So it's become quite tax inefficient for the kind of amateur buy-to-let landlord who thinks that property is a quick way of making money and an easy way to passive income. Passive income is probably much easier when it comes to investing in the stock market because there are tax-efficient ways of doing it through ISAs and pensions. Plus, you're able to access your funds a lot easier because they're liquid assets as opposed to property, which is an illiquid asset. So there are different considerations whether you're looking at it personally or looking for a community perspective. But again, when we look at the stock markets, we don't go after, we wouldn't, if we're not qualified, if we don't have the time to research each and every company, we're not going to go and just buy shares in Facebook or just buy shares in Amazon. We would give funds to a manager or buy a tracker fund or something because that diversifies our risk. So our risk is diversified across 500 companies. So even if Facebook today were to go bust, you wouldn't be exposed too much if you were diversified across 500 of the largest companies in the world. Contrast that with buying a property. If you buy property at the wrong time, in the wrong area, and it doesn't increase in value, and the tenant then can't pay, you're highly exposed. You're putting all your eggs in one basket. You're concentrating your capital just on one particular asset, where overall, if you average that out over time, you may not get the same returns as if just parking those funds into the markets, for example, where you may get a stable and a 5, 6, 7, 8, 9, 10% return without that risk of just going into one asset. So these are the considerations to have, and obviously speak to experts. But I think from a community standpoint, we need to get over this fear of the markets thinking that we could potentially completely lose our money. I think this goes back to our days maybe when there were the stock market crises of the 80s and people did lose a lot of money. But now with a lot more information and advisors helping to say, well, actually your capital is diversified across several hundred of the top companies, and therefore the risk of losing your capital is minimal compared to, let's say, just investing in one. Something, maybe you can put some data to this in terms of this mindset of property versus stocks for people's benefit.
Yeah, I mean, as a financial planner, I always question about different asset classes, and the thing is, there's no right or wrong answer. I mean, our community's benefited hugely from the last 15 years in, property prices. But the thing is, we can't look at things with rose-tinted glasses, right? So the boom in property since the great financial crash of 08, 09, when basically, we were handing out free money. Let's be honest, it's been a decade of, the magic money tree that just kept giving and giving and giving, which is now, they're starting to work out that maybe that wasn't such a good idea. But, you go back previously as well, interest rates were all, in the double digits, like in the 80s and stuff. And property wasn't that easy, like, let's just go and buy to let and rent it out in hunky-dory. It's going up at 6, 7, 8%, and the yields are 8% and stuff. That's not always been the case, but we always just look at what's happened recently, and as the rose-tinted glasses, where there is a risk in property, but we don't see the risk as much because of the fact that at least we can see the asset, right? At least I can touch it, I can go there, I can see it standing, whereas, digits on a screen, and you don't even get a piece of paper now, like saying that, you own shares in 1,000 of the biggest companies globally, that means absolutely nothing. But also, you talked about risk, and we can even dive into, what do you mean by risk? Because I'm sure if you asked every single person in this room, including me, the definition of risk, we'll get 20 different answers, and we can touch upon actually what is risk, because that's another word which is loaded, right? You're thinking about something else, to me perhaps. But the problem with the difference between property and the markets is simply that one is an emotional roller coaster, the other isn't. Okay, and the reason it's an emotional roller coaster is because you get up-to-date live price information. Okay, and that causes people untold amount of grief. They did a study in the US with Fidelity. You've heard of Fidelity. Fidelity did a study on their account holders who held stocks and shares investments with them. And they looked at the top performing accounts, so the people that had made the most gains on their share portfolios over a given period. And because they were interested, what's the secret source that these people have made more money, from their accounts? And so surprisingly, when they did this study in the US, they started to ring round all of the clients that had the most gains on their accounts. And do you know what they found? They were all dead. Okay, they were dead. So the people that performed the best investors were the ones that had died. And the reason being is because the best investor is one that doesn't look at his account and therefore can't chop and change. And so they were shocked that actually, wow, the top performers are the people that passed away. So then they looked at the next group of investors who had performed really well. And guess what? The next group of investors had forgotten that they'd even held investments on that platform. Again, which shows you the fact that ignoring your investment and ignoring the noise and the constant fluctuation in prices is so important when it comes to investing, because otherwise we're constantly in that fear and worry when we see it dip. Now with property, you don't have a ticker above your house which tells you every day down 2%. Okay, or you come home and you look at it, it's up 3%, right? Whereas with your share portfolio, you're going to get that kind of ping to your phone every day, which really makes it hard to be an equity investor. So we need to, to become better investors, we have to become better at behaving when it comes to investing, and that's a whole, different discipline. But maybe if I do share something that might be of help, just quickly, just around, since we're talking about the stock market. Let's see if we can do this. Slide.
Go to the window.
I'll go to this here. Okay. Okay, so this is just something to put together. But when we think of the stock market, there's a lot of fear. But if we actually just started to reframe the word stock market with big businesses, and we've got a group of big businesses here, and that's literally the stock market. Now, I don't want to dive into the ethical considerations for some of these companies, but at the because that's a different debate. But the stock market is a group of companies that we actually support day in, day out. I mean, pretty much everyone here is carrying a device. The company that makes and manufactures that is on the stock market. All of our cars are probably manufactured by a company that's on the stock market. We shop at shops that are listed on the stock market. I mean, this tech is probably all listed on the stock market. So we're supporting it. They're companies that make goods and services that human beings consume, and they're always innovating. And that means that they're always going to bring out new goods and new services that not only our generation, but generations to come are going to consume. Okay, and therefore these companies are going to get bigger and better. And if they fail, then new companies will come in their place. So starting to reframe the big businesses. Okay, we'll just ignore this. But historically, if we look at global equities, and this is data over the last this is about 100 years. The average here for global equities is 11.9%. Okay, and this chart here just says the percentage of time that the market is upward in direction and the percentage where it's negative. So we know that historically markets have been going up 75% of the time. And so then, when people say, well, when's the best time to invest? It's now, because probability is that you're, in a period that's going to be going up. Maybe not this day, but very soon. So you don't know actually when the real downturns are going to occur. And so based on this data, the really important thing is that if you look at the best calendar year and the worst calendar year, you've got such a big spread that the best calendar year for the global stock market was 55.9%. The worst was -30. So if anyone ever asked, well, what could the stock market do this year? Well, the answer is the worst case scenario is like globally, it's like -30. What's the best it could do? Well, 55. That's just taking like the best or worst year in history that we've got recorded for this type of a portfolio. But the idea is that over decades, you're looking at an average of in excess of 11%. Okay, so and look, I know data is manufactured a lot of the time and etc. But the idea is that over decades, the returns take care of themselves. We don't actually have to worry about them. And people often say this is the UK stock market going back to 1925, and people say, oh well, political parties, if it's a Tory government, the stock market's the economy's going to do better. It's nonsense. The capital markets don't actually give two hoots about who's in charge, because innovation and human ingenuity will always be taking place, and we can see through these charts that whatever events taking place in the world, whoever's in power, the stock market's continued its permanent advance. But there have been dips along the way. We can't get away from the fact that we live in a cyclical world of boom and bust, but good times and bad times. And there's got to be an acceptance that when you're investing in something that's going to give you better returns than cash, you're going to have to accept some level of discomfort. Otherwise, the cash returns would be where we would make our money, but that's considered a risk-free asset. But it's not really risk-free because we know that it's inflation is eating away. And so when it comes to risk, the real risk is this thing called inflation. because it's like carbon monoxide. Like you don't really know it exists until people started talking about inflation being double digits. No one really cared about inflation. I mean, let's be honest, no one mentioned it at the dinner. Prices are rising by 10%. No, we weren't talking about it, but it's pervasive. It's always been there. If inflation is only running at 3%, the cost of your lifestyle will double every 20 years, give or take. Yeah, so you've got to think, if your age, if your average, monthly bills, mean that you're spending 50 grand a year, in 20 years time, that's going to be 100. Okay, and that's just at 3% inflation. So if you're not doing some serious investing with your money, or your income is not going to go up in line with inflation, then you're going to see a complete drop in the standard of living, and that's why when it comes to retirement, it's so important that, you've invested and you've inflation proofed, your investment. So yeah, and the reason why there's a picture of an ice swan there, probably not in the Kodja community, because we probably don't do this, but at a wedding, you'd always see like this nice ice swan sculpture, that would be there at the beginning of the day, and everyone's taking pictures and it's fabulous, but slowly as the day goes on and there's a lot of heat built up in the room, that ice swan starts to melt, and by the early evening you can't actually tell that it's a swan anymore. But nobody at any point in the day could have pointed and said, oh, that's the point when it got disfigured, because it's ever so subtle. It's just drip by drip by drip, and before you know it, the ice swan is no more. It's the same with our wealth and inflation, just drip by drip by drip. Years pass and our wealth value decreases, but no one notices it. And it's like carbon monoxide, it will kill you and you won't even know about it. Yeah, because it's tasteless and doesn't smell. The risk that a lot of people, though, focus on is this permanent loss of capital. So think about the turkey just before Christmas, yeah? So all the turkeys now are getting fed, and they're all talking to their turkey friends, and they're like, this is fantastic. We're just getting fed every day. This is brilliant. Like, what? We're so lucky. And then all of a sudden they start seeing, just before Christmas Eve, one by one, they're getting taken out and not coming back. And that's, sayonara, good night. Now, we don't want to be like the turkey at Christmas, where we put our money into something because, we see a trend, we get FOMO, and suddenly we see something which, everyone else is investing in is going up and up and up and up and up. And it's like the turkey, right? So turkey at Christmas, hey, this is fantastic. This is just going up and up and up. I'm getting fed, I'm getting rich, I'm getting wealthy, it's feeling good. And lights out to the slaughterhouse, that thing that you've invested in has gone to zero. There's been many things in the past. There's been the tulip mania of the 1700s, or where people started buying tulips at crazy prices, and then they were going for extortionate. It was just a Ponzi scheme. It was just like human beings going crazy over tulips. People thought that they were suddenly a store of value, and speculating on tulips going up in value. And suddenly it all came crashing down. So the risk, and that might be the risk that you were talking about, you're thinking about this risk, like, oh my God, my investment is going to go to zero. I'm going to be brave and I'm going to say, listen, if you invest globally in diversified stocks, it can't go to zero. It's literally impossible, because if you owned 1,000 of the biggest companies globally, how can their share price all go to zero at once? Like, it just, unless a meteor hit like planet Earth and everything just collapsed, in which case you're not really worried about your stock portfolio anyway. So when you spread your risk like that, it's not that permanent loss of capital. Yes, the values can change, definitely, but as we've seen, it would only be if you sold, at a time when markets were down, and markets will be down, and we'll have several more of these crashes and periods of instability. So permanent loss of capital is definitely something that we need to avoid. If there's one thing to avoid schemes that offer the permanent loss of capital. Don't want to go near those. And then the last risk is volatility. Now, this is the thing that people are scared of because it's the roller coaster. Yeah. Now, the roller coaster is okay. It can be fun for some people, can be a bit scary for others, but you never jump out of a roller coaster. And it's the same with your investments. If your investments are ones that fluctuate in price, i.e. like stock market investments, you just stay strapped in. Yeah, you know the ride is going to come to an end, so you don't do anything drastic and you stay strapped in. But volatility, the ups and downs, that's why you get the returns. That's why you get the 10, 11% a year, because you're willing to accept the ups and downs. And that's why people in cash don't get that. Because it wouldn't be fair, would it? It wouldn't be fair to invest in cash and get more than accepting the ups and downs. It's called the risk premium. It's inbuilt for a reason. There's a reason why you get those returns, because you've put up with the uncertainty and the ups and downs. So anyway, I thought that might just be a little bit useful just to cover off. But again, you see, you shouldn't give me the mic because then I just talk.
If I could just quickly, gentlemen, but just quick show of hands, how many people currently invest in the stock market? Yeah. Not cryptos, not altcoins.
No, stop.
So based on that, if I could throw a quick maybe 4 or 5 questions at you both. So firstly, we've seen the advantages of investing in the stock market, etc. As somebody who's new to it, as a retail investor, 1, where should one start? 2, ETFs, trusts or individual stocks, what's the best option? 3, ISAs or individual portfolios? And 4, what is ideal ratio when it comes to saving and investing? Is there this ideal ratio that 70% goes into savings, 30% into investments or anything like that?
Okay. Like, we need to wrap up. You just asked like about 2 hours worth of content.
This is just the first theme. We've got 2 more themes to go through.
What do you mean by saving and investing? I think that's important to clarify.
So saving is your rainy day fund. Your money under the mattress for when the boiler goes down, when something goes down.
So going back to the principle of like layering the cake or the foundations or whatever you want to call it, but your emergency fund needs to be done before anything else, and so at least have £1,000 tucked away for if the boiler breaks down and it needs to be repaired, or your car, etc. So that you're not having to do something which involves having to borrow money from people that you don't really want to borrow off, or putting on a credit card, or payday loan or whatever it is. So that's the first thing. But then generally 3 to 6 months is a sensible amount, because, how long is a piece of string? Yeah, but, if you've got 3 months up to 6, depending on if you're employed or self-employed, that might change the dynamic. But once you've got that money, that just gets put into something like, premium bonds is good. I put my emergency fund in premium bonds just because I want it out the way. I don't want it linked to my main banking. I don't want to see my emergency fund. Because, do you know what? Like, if I need a new set of golf clubs, and I'm like, there's money in there, So out of sight, out of mind. It's there. So whacking it in premium bonds, where you actually have to make an effort to go and withdraw it, I think is fantastic. And who doesn't like winning prizes now and again? It's quite fun to get an email saying you won 25 quid. So yeah, so you put your emergency fund. Once you've done that. So you need to do that ASAP. There's no waiting around. That needs to be done, pretty quickly. And then you can start putting money away. Now, how much do you invest? This is where you really need to know where you're headed, because what I need to invest and what you need to invest and what Reza needs to invest is totally different based on the lifestyles that we want, and also what we can afford to put away as well. So there's no hard and fast rule in terms of, you need to do the sums and say, and this is a mistake a lot of people make, is that, if you're employed and you've got a workplace pension and you're putting in some and your employer's putting in some, you might think fantastic, but that might not be enough over 20, 30, 40 years to get you anywhere near where you want to be, because you want a certain lifestyle. And that's the thing is, all of this investing, malarkey, what's it there for? it's there to be able to give you and your family a certain lifestyle. No one really cares whether it's a pension or an ISA or whether it's with Legal and General or Fidelity or Hargreaves Land. Like no one really cares about that. What they care is, what is this money going to do for me and my family? And so therefore you need to get clear on how much you need in the future and then kind of work backwards. And that's where I guess you do need to put a bit of effort or maybe speak to an advisor. So that split, you know, if there was a rule of thumb, it's the amount that makes you uncomfortable is the right amount. So if you're putting away £200 and you're like, not really feeling it, then that's not enough. Yeah. Whereas if it's like £500 and you're like, oh, £500. It's like when you give charity, right? What's the best amount to give for charity? It's the amount that makes you uncomfortable that you have to think twice about giving because it's like, oh, it's a bit too much, really. You know, then you know that's the right amount because you're stretching yourself a little bit. And it's the same when you're investing for your future. I think if you stretch yourself, that's a good amount. So hopefully, I don't know if you've got anything to add to that.
No, I think Shabbar, you answered it well. And just reiterate your last point that it's not, you know, we think that we can time the market, but we can't. Even the most experienced and educated of fund managers don't do as well as you know they would like, and you know the average tracker funds outweigh the fund managers. So it's not about timing the market; it's about time in the market. So not timing the market, time in the market. So you know you probably heard of dollar cost averaging, where you just put the same amount in every single month, whether the market is up or the market is down. Just put the same amount in every single month, and that will then help you to average your returns out over time. So when the market is down, the same amount that you're putting in will buy you more units, more shares for the amount that you're putting in. So overall, the long-term wise, and particularly when it comes to investing for kids, for example, using child trust funds that you have here where you can invest tax efficiently and things like that, they're quite good ways of you know helping kids to have their own capital when they get to university age and or deposit on a house and things like that. So time in the market, not time in the market.
What's your personal opinion? ETFs, individual stocks?
Well, I think we've already covered it off in terms of individual stocks. Very hard to pick. If the best fund managers in the world get it wrong, what hope have we got? We're not full-time researchers to try and pick which horse is going to win, and you might as well kind of put a little bit on all of them. And that's going to give you a better chance of being up overall.
Thank you very much. Question for Shabbar. We talked about investing in future and paying pensions, and so I'm employed by NHS, and the way the pension is going to bite us and have started biting us in terms of taxes. You can't think of really paying for yourself and then for a certain lifestyle. So I suppose it's, without going into specificities, I think we need to be thinking about wider generic advice coming out of pension really. A lot of people working alongside me are really thinking on those lines. So you have got to be on that.
So when you say just the tax, so you're saying the taxation side, what's the...
So pension pot, for pension pots, so there's a certain size of pension pot and certain contributions, yearly contributions, and it reaches a certain level where it starts biting us because there's a tax bill.
Yeah.
And I know people who have to remortgage their house to be able to pay that tax bill. So there are a lot of barriers being placed within the current environment for people.
Yeah, I mean, that's quite alarming if people are having to remortgage their houses to pay the tax bill. And I guess the NHS is a bit quirky because without going into specifics, yes, there's a limit to the amount that you can put into pensions each year, and then there's an overall limit. When you breach that overall fund limit, you will then start to get taxed on the excess above that, and that's what the brother's referring to. And with the way that the NHS pension scheme works is that it's very easy to get tripped up when you start to become a bit of a higher earner in terms of breaching that annual allowance, which is £40,000, which is the maximum allowable contribution to get tax relief in the UK, and that's from your employer and your employee. So just to break it down, if, let's say for myself, if I was investing in a personal pension, as long as I've got £40,000 worth of relevant earnings, I can put £40,000 into my pension. That would allow me tax relief on that money. So if I was a basic rate taxpayer, it would basically get me sort of £32,000 would be the cost, and I'd get 40,000 into my pension. Now, the issue with the NHS pension is the way it's calculated is slightly obtuse in terms of the method. It's not just a straight, you've contributed this much, the employer's contributed this much. There's a formula, it's quite complex, and people get tripped up. I think the only thing that you can say in that situation is that the NHS is still a very valuable pension. It's very hard to replicate what the NHS pension will give you in the outside market. It would cost you an awful lot of money to be able to replicate that. Now, how you manage that is an individual situation, and if you get there, it's a kind of a problem that you've got to deal with. And I hear a lot of people that say, well, you know, it's not worth, you know, investing more into my pension because I'm going to get taxed at the end, etc. I mean, that's a nice problem to have. You know, if you're going to have over £1 million, you know, of benefits in your pension, you know, that's a pretty good problem to have. But at the same time, no one wants to, you know, pay extra to the tax man. I don't really have an answer for that because it's a very individualistic. So you've got to look at your own situation and say, right, well, you know, if you give up your right to invest in your workplace pension scheme, right, well, where does that leave you? You've got to do a cost-benefit analysis, which is tricky. So again, you're probably going to need advice in that sort of area. But the NHS pension is still very valuable, in my opinion.
Can I jump to one more thing?
Yeah.
Yeah, so we've received one of these questions online, and I think it's quite prevalent to a lot of people here. Question is, what is the advice the panel would give to people who have a mortgage on a SVR, so this is standard fixed rate to 7 points, or fear the increase of interest rates may have on their monthly repayments?
You stop.
Again, so what's going on with interest rates? It's spooky at the moment because of a very sudden increase, because obviously things that were going in the macroeconomic into too much detail. You know, some of it's quite complicated with gilt yields and blah blah blah. So banks got inflation is high. You know, we need to get that under control. So one of the ways is using interest rates. Now, actually, some rates have been coming down. So, you know, as people become a little bit less kind of fearful long term, you know, maybe that's causing a sort of a bit of a readjustment, not massively, but we could have further rate hikes. So if you're on the standard variable rate, the problem is no one's got, you know, everyone asks this question, we don't have a crystal ball. So what I would do is you've got to do some sort of scenario testing. So you need to you need to go to a mortgage calculator. This is what I would do. You know, if you Google BBC mortgage calculator, you can go and you can put in your amount of mortgage, and then you can play around with different interest rates and see what your monthly repayment is going to be. And then you can start to get a good understanding, knowing your numbers, that, okay, if my mortgage was 5, 6, 7%, what's my monthly repayment going to be? And then you can start to gauge whether, you know, that any of those scenarios are still going to be affordable. It could be that just, you know, nothing's affordable at the moment if you're in that sort of predicament, in which case I just don't have an answer for, you know, how would you then earn more, or maybe how do you spend less in other areas? So that's an individual situation, but you do need to stress test. Now, whether you now fix for 2 years, 3 years, 5 years, or do you go onto a tracker, you know, that would again be trying to guess what's going to happen with rates. And again, that's just impossible. You know, different analysts say different things. Some people believe that we're going to peak at, you know, interest rates of maybe 4.5%, 5% in the summer of next year. So if that happens, what does that mean for your average 2-year or 5-year fixed? I'm not well versed enough in mortgages to make that decision. I think you've got to be prepared. And what did the sister say? What was that? I've actually got it here as well. What's the advice?
It's definitely fun.
Oh, what is the advice?
I think you've answered it.
Yeah.
SVR.
Yeah, know your numbers, do a stress test. BBC mortgage calculator is good. Just plug in the numbers and just see, based on the different scenarios. I think that's the only thing I can suggest. I don't know what's going to happen with interest rates. They're going to maybe go up a bit more, I think.
Yeah, I think just something to add from observational purposes on the mortgages. If you're on an SVR, you're probably paying a lot more than you should be. So it probably makes sense to look at the fixed rates, particularly if your income is likely to stay the same, then you don't want to be exposed to the SVR going up. So it might be better just to look at what the fixed rates are and lock in at a fixed rate, even if it's only for 2 years. Look at the total cost, so at least you're covered for the next 2 years. And as Shabbar said, there was a period of time a couple of months ago where the rates were going really high, but they seem to be balanced out. So now is probably a good time to really look at the best deals out there and get on a fix rather than be exposed to the SVR.
Do we have any other questions on the floor?
Just to go on, Martin, you asked a question about the stock market, and I noticed that there was limited numbers that held their hand. So personally, I only just started investing in the last 3 months. Not the best at it, but there's these online platforms that allow you to copy followers. I do have the knowledge, so you can sit back and then you can basically let them do the work for you. And as they've got the experience in the stock markets, etc., they know that the best time is to sell and the best time is to buy. So those who are hesitant or may not have the time to spend, like traders or those who are working 9 to 5, Monday to Friday, or even Monday to Sunday, it is a good start because you can leave, obviously the stock market is not perfect, but like Shabbar, you said, you can lose, you can gain, but then have knowledge of the times.
I didn't say you could lose or you could gain. So let's just rephrase that. You only lose if you sell in a. So this is really important just to understand, and it's great you started investing. And it would be good to just find out when you say copying other traders, like what are they investing in, etc. Because again, don't want to mislead anyone. But this whole idea of losing and gaining as well. So we've got to think of it in terms of price fluctuation. Okay, so the price of your portfolio, whether it's a fund or let's say if it's individual shares, will fluctuate. What causes the gain or the loss is when you decide to liquidate that position, and that's vitally important. Yeah, so if we're going to be good investors for the future, we kind of have to get into that frame of mind that it's only a loss if you decide to sell when the market's down. We know that the market is up 75% of the time. History has told us that, and we know that the stock market has been on a permanent uptrend with temporary downturns. So I needed to just want to make that sure if there's people listening.
That's fine. So you asked a question about how it actually works. So the traders, they invest in either the S&P 500 or other traders that deal with currency, but they do have a wider range. And what happens is when you select to follow them or copy them, when they open trades or close trades, your percentage that you invest in will replicate them as well. So it is an option for those who are hesitant, who don't have the time or knowledge in the stock market.
This is day trading, right?
Yeah, on stock, day trading.
Yeah, so just as a caveat to that as well, I don't subscribe. That's not part of my investment philosophy, so I'm not going to endorse that, because the important thing as well with that is copying someone else's strategy on the basis that they're an expert is also, well, how do you determine that person actually is an expert, because you can only judge someone's performance based on historically what they've done. There have been some giants in the fund active management world that have had great track records and then fallen off a cliff in disastrous fashion. So the strategy, if you're going to adopt for investing, is picking a globally diversified multi-asset fund. That's the safest way to invest, hands off, by buying global companies through one fund. It does it all for you, and you're exposed to thousands of companies globally. That's the philosophy that I subscribe to as the best way to invest. Individual stocks, copying, etc., you can do, and you might make great returns, but I don't know if it's a sustainable long-term way of investing. So yeah, I think you just need to be cautious with it.
I think it would help if you I don't know, if you put up like a chart for the S&P 500 and then show what it looks like, let's say in 6 months, and then a year, and then 5 years, and all time, just to show the growth curve, and then show what the drops look like as well, just for everyone's.
We can have another question while I'm sort of searching.
I think it's just similar to what Musaddiq said. I think when I talk to my friends and in our circle, one of the things that I find amongst us is that there is a lot of information out there. There's information overload, and and I think what I find is that every advisor or every person on YouTube will tell you investing, for example, S&P 500 or FTSE 100, FTSE 250, all of these, their advice. And I think one of the stumbling blocks that I find within our friends here that I've experienced is taking action. And that is the one thing that's really stopping them. And the reason could be anything, could be fear. One of the biggest reasons is fear. I don't know what's going to happen. I'm going to lose, I'm going to lose 500 pounds, whatever it is. Okay. And I think what we as a community could benefit from professionals is sometimes we need hand-holding. That's exactly what we need. We need hand-holding. So when we give this information out that these are the options, you get into properties, you get into stocks and everything, I really think as a community, just as a feedback to take on from here, that we should really have a day seminar trying to handle these people. Say to them, look, we're going to work together like brothers. Imagine if you're my brother or you're my son. This is what I would teach my son to do. So what I'm teaching you here, I know that we have to be protective of our own advice, it's all fine. At the end of the day, these boys, youngsters need handholding. And I really think that there should be a program out there. And okay, there's a disclaimer out there, but really, to really benefit them. So look, you're going to start off, okay, let's do this. What's your goal? What's the formula? I mean, one person can have a financial goal of 50,000 pounds, another one could have 100, but the formula is the same, right? And I really think just that we should have a handholding. So just to wrap up, I mean, what's one thing we should take away from today? It's a difficult question, but one thing we should do is take away from here today, that we should go out, read about it, and take action. So that if this whole thing doesn't just come in like, we've heard about this, but we didn't do anything. So what would you advise? We should do one thing, go away from here and take action.
Go first.
So I think what I've learned from Shabbar to take away from today is to know your numbers. Look at what you're earning every month, and as Shabbar said, firstly, look at. I mean, ideally, you want to, and that's why you go to someone like Shabbar as a financial advisor who can help you with your modeling, because you will need a certain level of income 30, 40 years down the line. But if you're not a financial modeler, accountant, financial advisor, you'll struggle to do so unless you go online and try to find some calculators. But at the bare minimum, as Shabbar said, first of all, you keep aside your emergency fund. Emergency fund, put that aside, put it away from you so you don't even see it, but it's there should you need it, lose your job, something comes up, whatever. Then look at, okay, so what is that uncomfortable sum that I need to invest? Take that out, and then that sum, take action upon it. Now, me personally, someone gave me advice a few years ago to say there's no point trying to pick selective stocks, there's no point trying to even buy funds. Put your money in a tracker fund, someone like Vanguard. You may have heard of Vanguard, they're very cheap trackers. You put some in there, they even have, depending on how old you are and when you're going to retire, they will have like a 45-year fund. So I think when I put it in, it was a 45-year fund. It just puts in there, there's their spread, the actual fees that they take are minimal, and then it just disappears. It just goes in there every single month. So you could do something similar to go on to something like Vanguard, pick a tracker fund, which will give you that exposure. So I think that is something that we all need to do to actually take action, because remembering this fear that we have of losing capital that we put away is unfounded. It is an emotional fear, not backed by any rational or logical reason. It is an emotional fear because of what we heard, because as Shabbar said, we see these volatilities, we hear about stock market crashes, but it is unfounded. It is impossible, as Shabbar said, that 1,000 companies will all go bust at the same time. So rest assured that that's not going to happen. So the biggest risk, the biggest cost is not doing anything. The greatest cost is the cost of inaction. So when you see it that way, then you have to take action, because if you're not taking action, then there's a bigger risk that your money and capital will be eroded. So that's the one big takeaway, that is your biggest cost, and therefore go away and take action today to put your excess or put some savings into a wrapper that will grow over time faster than the rate of inflation.
Yeah, I'm going to come on to that. The brother asked to show a chart, so I'm just going to quickly do that because this is quite useful. Okay, so S&P 500 should be okay. So you can see that. Okay, so the S&P 500 is standing at 4,026. That's just a number to measure the value of the index. It tells you the aggregate value of that index, so you can compare it to previous periods. But if we go back to, so this is 1978. Okay, Reza, you're gonna have to do the maths. Okay, so in 1978, 1st of Jan, 2022. So what's that? 78. How many? What's that? 44 years. So in 44 years, the S&P 500 is up 4,079%. So if we're going to convert that into, let's say you put £1,000 back in 1978, I don't even know what the maths is, like huge. It's huge, right? You're talking millions. Now, okay, so we can see that it's gone up by that much over that 4-decade period, yeah? And we're all kind of going to be investing for decades, 4 or 5. I mean, if you're in your 30s now, you're going to be investing until you're 80, easily, 5 decades. So that doesn't look too bad. I mean, that's pretty smooth going. It looks like a pretty decent chart, and, not too many bumps in the road. Let's just look at it year to date. Holy moly. That's crazy. Like, honestly, that would give me a heart attack, and I'm a professional, okay? But this is what the perspective of time gives you when you're an investor. We're not worried about days, we're worried about decades. So if you're going to look at stuff on what's happening at the moment, like, you're just going to be lost. Even if we looked at, 3 years, again, we've got the pandemic, and then it's picked up, and then we've had the current crisis. So it's really about the perspective that over decades, again, you see, it doesn't make sense for it to be any other way, because if you think about why do people go into business? Who owns a business here? Hands up. Who owns a business? Okay, why are you in business? What's the reason? What's the sole reason that you're in, that you've decided to invest in your business?
Long-term investment.
Yeah.
Long-term investment, work for yourself.
Okay, what else?
Money.
Freedom to make money. Oh, yeah, make money. Profit. Yeah. No one's in business to not make a profit, right? We're all in it to make a profit. So, that's exactly what these companies are doing globally, right? They're all in it to make a profit. I mean, there's very few that are, doing it for, the good of humankind. There's a few. So they're all doing it to make a profit. So, if I see a business owner in the mosque, like who's making huge profit in his business, I'm probably going to go up to him and either try and start a business with him or maybe invest in his business. And that's what we're doing as investors. But we're just doing it through a vehicle that allows us access to thousands of global companies. They're all in it to make profit. They've all hired the smartest people on the planet to run those companies. So are they going to fail? Well, yeah, a few of them will, but the majority of them won't. The majority of them will carry on producing things that we need. And therefore, if they make more profit, that's good, because as they make more profit, they become more valuable. So their share price goes up. And so therefore we have that, ongoing upward trend, and that's what, investing is. But, look at it over day to day and you're going to be in for a heart attack, Now, what the brother at the back said was vitally important. There is so much, and you can't do it justice in like a small session, because we're all at different stages, etc. So yeah, there is plans that even at Hujjat, we're thinking of like, how do we modularize this so that we can have like different finance modules where we can just run them, and people can do them in different Jamaats just around like the basics of, financial education, literacy, etc. And then just moving up the chain towards, okay, well, how do you select an investment fund? What's the way to do it without giving advice, but just the guidance? You still got to go out and then do it yourself and pull the trigger, but hopefully you'll have just a few more tools to help you to do that. So that's the pipeline. I'll just echo what Reza said. Reza said it's just about knowing your numbers. I think that if you don't do it regularly, and if you don't do it with your other half as well, if you're in a relationship and your wife, and you don't sit down and do your numbers together, so as a household what's coming in, what's going out, what are your priorities, what are your goals, that's vitally important. Because at the end of the day, the thing that and this is all about being happy and unhappy as well, right? Money just creeps into every single facet of our relationships on this planet, like whether we like it or not. It's just, everything is, pretty much interlinked. And knowing your numbers actually brings an element of clarity to the situation as well. So I would urge everyone, because that's a solid base. So yeah, thank you very much. Oh, Chris.
I can ask straight. When you say we invest in the stock market, but we're using a vehicle to do it, for example, a pension fund or an ISA, how do we know which vehicle to use? So I've heard on the news of so many pension funds collapsing, for example, or them taking so much fees to allow you to invest. How do we pick? Because I've had an instance where I was trying to put into ISA, and you read the books, Rich Dad and Poor Dad, and then it opens up a paradigm. And NetWest flashed on their app, it flashed up to say, "Oh, invest in ISA," and I just did it. And then I was working, and they said, "Oh, we're going to put 6% in." I said, "Okay," I just did it with Royal London. I don't know if that vehicle itself is the right place to do it with.
Yeah, gosh. I mean, it's such a good question, and it must be one that everyone faces, because it's that worry and fear about doing something wrong when it comes to your money, and there's so many options out there. As long as you're investing, so charges are important, but you shouldn't be paying like more than sort of 0.5% for the management of your fund. So a quick thing about charges, this was probably end up going on and on, but let's just try and cap it up. So when you invest money, there's different layers of charges, so it might be important just to know this. So if you go to somewhere, have you heard of Hargreaves Lansdown?
Yeah.
Okay, Hargreaves Lansdown is a platform which allows you to invest in thousands of funds to choose from, Far East, Middle East, Japan, North America, South America, Europe, UK, different funds and different asset classes, stocks and shares, bonds, property. But then you've got multi-asset funds, which will basically give you all different assets in one fund. So you don't have to go out and buy different ones. You could get it all in one fund. And so if you went to Hargreaves Lansdown and you said, right, okay, I want to buy a fund, you'll have Hargreaves Lansdown will charge you a percentage for using their platform. Yeah, so that's their platform. And then you could have an ISA, a pension, and just like a general investment account. You could buy like individual shares. So you could have it all on Hargreaves Lansdown, and they're going to charge you a fee for the privilege of holding that. Then you're going to have a fund charge depending on the type of fund. Now, different funds will have different charges, but generally, if you're choosing what would be called an index or a tracker fund, what we've been mentioning, like those are very, very cheap. Like you could be paying, 0.1, 0.2, 0.3%, for the fund charge. If you're going for an active managed fund where, you've got someone who's doing research and looking and picking and buying and selling and being more active, like you can be paying up to 1.5%. Okay, so you can see that the cost is building up. So if you went for the low cost option, Hargreaves Lansdown, for example, this is not an endorsement for Hargreaves Lansdown, I'm just using an example. They charge 0.45% as a platform charge, and then you'd have your individual funds. Now it's up to you how many funds you pick, and you would determine, if it was just one fund and 0.2%, then you'd probably be in 0.65. Now that's pretty cheap to be investing. And sometimes they'll cap it at a certain amount per year. So you've got to look around and just see, for the amount of money that you're investing, which is the best platform and which funds you want to sort of invest in. Now, when you say like 6%, I don't think that would be a fund charge.
No.
That's
the pension match.
Okay, fine.
What the employer matches.
Okay, fantastic. So your employer is putting in 6%.
If, for example, they put in 6%.
And you put in 6.
You put in 20.
20. Okay. So.
Or 10%.
Okay.
10.
So that's just your level of contribution.
Yes.
Yeah, which is fine. And Royal London is a reputable pension provider. I mean, there's again.
How do you know? Who will tell you that?
Well, that's a whole different. I mean, that's where someone researches and tells you that Royal London is established with credit rating from AKG and other Morningstar and blah blah blah, etc. Have done analysis on them, their strength, their due diligence has been done, governance, and they've got billions and billions of pounds under management, so they're kind of probably bigger than some small countries. so yeah, Royal London are good, like in terms of they're reputable, so don't worry.
Do we have time for one more? Yeah.
I'm more worried about.
So there's one there. So there's last question. Sorry. So there's a question that's coming online. It's asking, is gold a good investment? And I think generally it opens up the conversation to alternative other asset types, commodities, cryptos, NFTs, the works. Now, I fully appreciate it's a very loaded question to go into, but what nuggets can you give us on that?
What gold nuggets can I give?
Exactly. Thank you for picking up on the fun.
We had a chat about this. Reza was good with gold and crypto.
Right. Depending on who you ask, you'll get a very different answer because everyone here has a different risk profile and a different risk appetite. Shabbar here is very risk averse, so he's probably better suited to answer this type of question. But things like crypto are not for the faint-hearted. it's very clear it's a very volatile asset class, store of value, whatever you want to call it. So it's not something to take, right? It's not something to put your life savings into at all. So if any advice I would give is, don't put your savings in that. Only put any money into crypto that you can afford to lose. And if you do lose it, it shouldn't affect your lifestyle. So approach it from that angle, because it is volatile, and nobody really knows what's going to happen to it. I have my own opinion. You have to be, but something like that, you have to be educated enough, not just do it because others are doing it. Do your own research, and if you feel comfortable investing, then that's on you. But it's not something that someone like an esteemed financial advisor would be recommending you to do.
And Reza, sorry, before you hand over, what are your thoughts on gold? Because as and we touched on the fact that as a community, as Asians, we've generally been a bit resistant towards stocks, but gold has always been the one thing. When somebody gets married to the family, you normally get gold. Gold has been that sort of cultural asset that we've always leaned towards. In the current economic climate, is gold still a viable asset? Is it still something worth investing in?
To be honest, I have no idea when it comes to gold. I have no experience in buying gold, having gold, anything like that. So I'm probably not best to comment. But I guess something like the reason why crypto is seen as an alternative to gold. Crypto is seen as a store of value, in the same way as gold is seen as a store of value, a hedge against what might happen to cash or stock markets or whatever. So. And plus, gold it's a very difficult asset to kind of. I know there are funds now where you can acquire gold trackers or whatever, but actually, being able to buy a brick of gold and things like that is very difficult. Storing it, there's charges for storing it and things like that, and that's why things like Bitcoin and digital currencies are seen as an alternative because they're very easy to hold. There's no digital; it's all in the cloud. There's no charges associated with actually holding the currency, as it were. So, and plus with gold, there's no income that's generated on it. It's just a store of value. So again, any financial advisor would tell you that don't put all your eggs in one basket. Rule number one of investments of where you put your cash and your wealth is to have a diversified portfolio. Have a little bit in different asset classes, just spreading your risk. So if something goes down, you're not fully exposed. Crypto and gold. Final word.
Yeah, I mean, I don't really have a lot to say about crypto and gold, to be honest. I mean, the data would suggest that gold is not a productive asset. I think it's an emotional, because it's like precious metal, but what use is it? I don't know, store of value, hedge against inflation, all of these things. But then, what the great businesses of the world are the best hedge against inflation, because what happens when inflation hits? What do companies do? What do? When inflation hits, they're going to raise their prices, aren't they? So there's not really, the best hedge against inflation is investing in global businesses, I believe, because they're the ones that are going to adapt, because they still need to be profitable. And so they're going to, raise prices, cut costs, improve, the efficiencies within the business to still maintain profitability. I've just been trying to look at some stats for the total return of stock market versus gold. I can't show this because I've not looked at it. It's just a website that I've picked up. But yeah, the total return of the S&P 500 just kicks gold to the curb, so over a 40-year period. So it's difficult, but it makes good wedding gifts.
Ladies and gentlemen, on that note, I'd like to thank Shabbar and Reza for your time and invaluable advice today. Can we end with a sort of Fatiha for the well-being of Shabbar and Reza's family and all our